and welcome to the Simplify Your Retirement Podcast with Stephen Stricklin. Hello, Stephen.
Hey, Paul. How's it going?
It is going very well. You know, it's hard to believe that we are wrapping up. What we've done up to this point is that we've done seasons. And seasons, you know, usually about 12 episodes and kind of all have a theme. And so we're wrapping up season 6. Hard to believe.
It is hard to believe. It seems like we just got started.
Yeah.
And I think we still have a lot to say. That's amazing.
Absolutely.
I don't know how we can keep talking about these things. This is at least 70 episodes.
Yes.
You think we'd be done. We'd be out of things to talk about, but it seems like every time we sit down here at the podcast studio, we have more to talk about. So it's exciting.
Yeah, absolutely. And so this season has been kind of the theme of this season really has been kind of the non-traditional products and things like that in relation to retirement, right? And so we know that people hear things, they see things, they have questions about products that maybe they hear about or something.
Right.
And we know in our industry, they like to create, you know, unique phrases to sell something, right?
Right.
And so like a LERP, you know, like a life insurance retirement plan. Well, it's life insurance, but they give it a fancy name. And so people think it's something new. So what we want to do is, because we're focused on education, we want to be able to really stop and educate on this and talk about some things. So like we touched on crypto.
Yep. Crypto this year. I know we talked about that, and we talked about short-term care.
Yeah.
And like you said, a lot of times people hear about certain products, certain investment opportunities. And I like to take this opportunity, this format, to talk about those things, because in a normal financial planning concept, or in a discussion in office or in a class that we're teaching, normally those ancillary products don't normally fit in, it's not relevant to talk about, but they're out there.
Yes.
And the thing about all products that someone's talking about, or advertising especially, is they sound good. Yeah. They all sound good. And again, in and of themselves, they may be good. They may be a good investment. We talk about this all the time. There is no such thing as a bad investment, only a bad fit. And so sometimes people hear about these things and it sounds good, and it may be good. And we've even talked about reverse mortgages in here. It doesn't mean that we think that everyone should have a reverse mortgage. It just means that it is a concept that could be relevant. Yes. And so we like to take this format right here, and we did that a lot this season, just talking about different things that could be relevant to someone they need to know about. Yeah. And so I'm going to go back and look at all the subjects, all the titles of the podcasts that we talked about in here. And maybe if you hear something out there, you can come back and see if we've talked about it before. Yep. And that's why this has been, it's been a good way to do it. And so like you said, we pretty much have gone by seasons so far. And the reason we've done seasons is because we can stay on one theme for that 12 episodes. Yes.
But before we fully put a bow on this season and look ahead to where we're going from here, what we want to do is we want to take and answer some questions, frequently asked questions. So these are questions that we hear because, again, this podcast is not all that we do. Right. I mean, here at Wise Wealth, we help people put together retirement plans that give them the freedom to give, serve, and enjoy life like never before. Yep. And so when we go through that process and we help them, and we're covering all the different areas of planning, from liquidity planning to income planning to growth planning to insurance and legacy and taxes, right? So we go through all that. We hear a lot of questions. And so we put together a few questions here. And I don't think you've seen this list yet.
Right. I prefer not to see the list. Yes. I mean, I think I'm better off the cuff than, and so we'll look forward to seeing what you've got.
And so we're going to answer some of these questions, because a lot of this season has been, in a sense, to answer questions that people have that maybe they're not asking. And so the first question here is this: how often do you make changes or rebalance my portfolio?
Typically, we like to rebalance a portfolio once a year.
Yes.
Once a year, rebalance a portfolio. And so one of the most important investment principles is always, buy low, sell high. Buy low, sell high. That's how you make money in the stock market. And what rebalancing does for someone in their portfolio, it allows us to sell high. In other words, during the course of 1 year periods of time in a portfolio that has 10 different asset classes represented. We know that in a diversified portfolio of the 10 asset classes, sometimes all 10 of them are up. Sometimes all 10 of them are down. Okay, it's rare for either one of those two things to happen.
Yeah.
Normally, there are some asset classes that are up, some asset classes are down. And what rebalancing does is it takes your original allocation percentages, and the ones that are up, it allows you to take advantage of that, by selling high. It allows you to take advantage of how it performed, but simultaneously you take those gains off the table, and now you're buying into something that is low. You're going to buy something that is down in value in hopes that it will go up. So it really does two awesome things for someone.
Yeah.
Because otherwise, if you let the things that have a gain, stay there, it may go back down. You may not have taken advantage of it. We know that really you only make money when you finally sell. Okay, so when you rebalance, you're selling high, you're taking those gains, but you're also simultaneously buying something that is undervalued. And so, but the reason we do it once a year is because, a long time ago, we've been doing this for a long time. A long time ago, I was a believer in quarterly rebalancing. But we realized if you do it every quarter, you're not giving the winners enough time to win. You're selling these things that are doing really good over a 3-month period of time, and you're getting all the gains and taking them out when it's still running. So we believe that a year is a good runway. So at least every year we're going to rebalance the portfolio. We're going to sell the things that are high, buy into the things that are low. And then what that means is 1 year from today, or in that annual rebalance, your portfolio is going to look like it should have looked to start. And this is important. The reason the portfolio looks the way that it did at the start is because that was based on your risk tolerance.
Yes.
That was based on standard deviation, your risk score. And so we always want to make sure that the portfolio is allocated in such a way to maximize diversification and to put you in an allocation model that gets you the rate of return you need.
Yep. And so the rebalancing, what you're saying is the rebalancing itself is to put you back to where you should be as far as risk tolerance and the way your portfolio is designed.
Absolutely.
The frequency, which you referred to, we used to do it back when your hair was black and I had hair.
We have the pictures to prove that. Exactly.
Back
that would
then.
be a different episode. You don't even remember when.
But the reason for how often is so that we can really then capture the buying, selling high and buying low.
Exactly.
Okay.
Absolutely. So, and maintain the agreed upon allocations, rate of return that we need to get, and that kind of stuff. But from just an actual investment success standpoint, it makes a lot of sense to do it that way, to sell the gains, to buy the things that are low. You're taking advantage of both. Now you're able to buy low and then turn around and sell high again later. So it allows you to do what you constantly should be doing in a portfolio, buying low and selling high, and an annual basis is enough of a frequency to make that happen.
Right. And so that's specific to rebalance. The other part of the question, and so these questions are kind of loaded, right?
Yeah.
Because there's the rebalancing and the timing, and so that's two really separate items put together. It also talks about how often do you make changes, and that kind of goes with the next question that people are hearing is: do you watch the market and move assets out based on short-term volatility? So, in other words, are you making changes to the portfolios?
Okay. Do we move assets out? And this kind of goes into what I was starting to say, in the previous question. And that is there's a difference between the portfolio managers and what a client should do. So let's talk about the portfolio managers. So let's say one of our clients is in a growth model portfolio that may be representative of 75% stocks, 25% bonds. That 75% stocks is made up of U.S. large cap stocks, U.S. mid cap, small, international stocks. So the mix of those stocks. A portfolio manager is going to pay attention to short-term trends, volatility, momentum, what's going on in the market. They may decide, hey, we need to put a little more in U.S. large, a little less in the U.S. mid. We may need to overweight here, a little underweight there. They're going to manipulate and manage the portfolio itself to take advantage of those market trends. And we coach our clients that the best way to make money in the stock market is time and discipline.
Yes.
So therefore, we don't recommend to our clients that, hey, you should get in the market, you should get out of the market. We should overweight, we should underweight. We never do that with our client portfolios. The portfolio managers are doing that. We might say to our clients, look, you're in a growth model portfolio. The only reason you're in a growth model portfolio is because your time frame for needing this money is 5 years or longer. The only reason you're in a growth model portfolio is because you need a 7 or 8% rate of return to get you where you need to go. That's what the plan is calling for. So therefore, our job is to choose the portfolio, choose the portfolio managers, trust them that they're going to do their part in managing the portfolio. Our part is to stay disciplined. Staying disciplined means we stay in the growth model portfolio regardless of what's happening on a daily basis, regardless of what the performance over a month, a year. We're looking at the performance of that portfolio over 5 years or longer. It always comes down to time frame, for the portfolio that you chose. We want to give it that time frame. For example, if someone needed a 8% annual rate of return, we know that there are some years that in order to get an 8% return in the market, your maximum drawdown, your potential, downside risk might be 25% in a given year. So we know that. But we know, so potentially it could go down, it could go up, but over time you want to average 8% a year. The only way to do that is to stay in that portfolio, regardless of the short-term volatility. So I hope that answers the question. Short-term volatility, we're trusting the managers to make decisions in the portfolio. But for our relationship with our clients is, we stay with the plan. Stick with the plan. The plan is designed to get you the rate of return you need over 5 year periods of time or longer.
Yes.
And in fact, I brought with me, I was hoping that, you might ask a question like this. I have with me a wonderful chart. No one can see this chart, but I've got a beautiful chart here. Okay. This chart right here says that stock market pullbacks happen every year and they all have one thing in common. So this is literally, if you can see my beautiful chart.
Yeah, I can see that. It's
every year,
up and down.
There's a red line in every year. They have a pullback every year. They all have one thing in common, a complete recovery with the passage of time.
Wow.
That's what every annual pullback has in common, a complete recovery with the passage of time. Stay calm and stick with your long-term plan. When I saw that quote the other day, I took a screenshot because I said, that sounds like us.
Yes.
Okay. And so it is sometimes our clients, they may misunderstand this whole concept of, buy and hold, or, maybe I wish, we had an advisor that would be more, telling us we need to do this and we need to do that and get in and then get out or move things around. But we know not only by experience, but we also know by the actual quantitative results that the biggest hindrance to an investment client's success is the person we look at in the mirror. Okay, so we call, behavioral finance. It's called investor behavior. The thing that messes up returns is normally us. We try to decide when to get in, when to get out. That's the thing that nobody can do. There's been study after study that shows if you miss the best 5 days in the market, if you miss the best 10 days in the market, we're talking about not a small difference in your returns. We're talking about a massive difference in your annual returns, therefore your lifetime returns. So therefore, you either have to be in the market or not in the market. You have to be in that asset allocation model because it's the only way to get you the rate of return you need. And we have to stick with it, regardless of what's going on in the short term. Again, trusting the managers, they're going to make changes to it. To try to minimize risk over the short term.
Yeah. And that chart that you were referring to, sometimes we have short-term memory issues, right? As investors, where we only remember what's happened recently. And what we remember of the past is not always the way it was. But not too long ago, there was something that happened where we heard something like, hey, just 2 weeks to flatten the curve, right? And so this thing happened. And in that month that we were told that, everyone panicked and the market tanked. But what happened by the end of that year?
Not only did it entirely recover, but I forgot what the positive return was by the end of that year.
Yeah.
And so you can't go by, and people try to predict. There's always the joke about the economist and the weatherman. You know what I mean?
Yeah.
These are the only two people that can get it wrong most of the time. You know what I mean? And still have their job. But the people that get it right, they look like geniuses. And so they throw out the people that predicted it. You know what I mean? Even though the last 50 predictions, he was way off. You know what I mean? So no, you can't predict.
Yeah.
A lot of things the stock market, knows in advance is publicly traded information. And so therefore, ultimately, one of the best things we can do for our clients is encourage discipline. And it's not always fun.
Yeah.
Okay. So in other words, and COVID hits, it's like, shouldn't we be doing something different? You know what I mean? Shouldn't we? And sometimes I get this question. Sometimes I'll meet with a client or meet with someone and they say something to me like, oh man, your phone was ringing off the hook right now.
Yeah.
And we always have to tell people, look, I mean, no, if you have a plan, if you have the right mindset and approach to the stock market, no, we don't have to panic. It is very rare that Paul and I are sitting in this office, panicking, or anybody in here, because we only put at risk the amount of money we can afford to have at risk, which is why everything we do always comes down to a plan. Should you have money in the stock market or not is always going to depend on if you have the time frame to do it. We're always comfortable with risk 5 years or longer. By the way, even an all equity portfolio, even 100% at risk, we're comfortable with that kind of risk over 5 years.
Yeah.
So therefore, it always comes down to expectations. It always comes down to really ultimately upfront. It's making sure you understand the problem with the industry. And here I go. Here we go. You got me going here. Finally, here comes. The problem with the industry is some people go to a financial advisor, and that financial advisor and his team in his research department, their value proposition is they're experts. They can time the market. They got an incredible track record. They know what's happened. They know how to predict and all these things. Yeah. And their value proposition is we're going to be constantly monitoring. Well, the reality is it doesn't work. We've seen the number. It may feel good. We've stood here many years and said, what, it may feel good to do something, but we know. And it doesn't mean that sometimes, we want to do something too. It's like, oh, we better do something. But we know at the end of the day, the best thing to do, if your time frame is 5 years or longer, if the asset allocation model we chose to begin with was the right one, we need to stick with that, because that's the only way to get those returns is to stay disciplined, let it do its thing over time. If we have less time, we need to do something different. If you need the money for income, we need to do something different. So that's why we take so much time up front with clients in the planning phase and really to set these sort of expectations. So I think that's important. I do think it's important for people to understand. And I know we had our portfolio managers here in the office here recently. And we have that available if anybody ever wanted to watch that video. I know we've got a video ready for a talk with our portfolio managers, because the point is that they have a job to do.
Yes.
They have a job to do, and their job is to watch the markets, look at the returns, look at the stocks, what's available. Should we change this? Should we pull this out? Like that question said.
Yep.
Should we take this asset out? Should we have that asset in? Yes. That is 100% part of the equation. That's the portfolio manager side. The client relationship side, the financial advisor and the client, we choose to have a plan. We choose to have a model. We choose to stay disciplined. And that's what works over time.
Yeah. And what you're saying too, all of that goes back to one of the principles, which is no investment decision outside the context of the plan. Right. And so if you're making a knee-jerk reaction to something that's going on, you're making a decision based on an external factor or something, not based on the plan.
Right.
So when you make the changes is when something in the plan changes. I need money sooner.
Right.
I need this at there are
and
times.
There's this technical term called FOMO.
Yeah.
Right. And so sometimes people feel like, hey, if you read the news, the natural reaction is sometimes it's going to affect my investments. In that natural reaction is not necessarily wrong. And there are times that people, there are a lot of times we don't sit on this podcast and necessarily talk about current events. And there's a reason for that. Every once in a while, we'll stand in front of a video and say, hey, everybody stay calm, stay disciplined. We know that everyone else is doing these things. So FOMO happens when you naturally react and say, well, we got to be doing something different. My point is the managers should be doing something different.
Yep.
They may be doing something different, but we don't. Number one. Number two, sometimes when things are happening in the market, the guys in the locker room by the cooler or the girls in the office, they want to talk about, oh, my financial advisor, he did that and the other. It's like, oh, well, really, mine never heard from mine. And it's not because we're not paying attention.
Yep.
I always tell everybody, I could get up here and cause everyone to panic every day. I mean, there's good news every day. There's bad news every day. We're watching it just like everybody else. But should that affect my behavior? No. In other words, the investment results, success, it comes from our behavior, not from reacting and timing and all these things. And there's so much, and I keep coming back to this. There's just so much data on this, where returns come from. And it rarely, if anything, comes from manipulating the allocations, buying in, getting out, overweighting, underweighting, timing. Very little bit of the returns comes from that.
And like you said earlier, time and discipline are the two things you need. Most people operate on fear and greed.
Right, exactly.
And that's where the problem comes in. So that actually, it's like you answered the next question before I even asked it.
I like that.
So now we'll work in reverse and we'll ask the question that you just answered. So
it's like Jeopardy, like reverse Jeopardy or something.
Based on what I heard in the news about XYZ, impending doom and gloom. How can I protect my investments? Or should I make a move in my portfolio based on whatever it is? And so that's it.
You can probably guess the answer. Well, ultimately, I would just say to that, that's why the plan is so important. The plan is so important. Up front, knowing, why, we always tell our clients, you should know why you have X amount in cash. You should know why you have X amount, let's say, in an investment that's going to protect your income stream. You should know why you have this much in the stock market. When people know why, it leads to peace of mind. Now, again, if we're talking to someone's watching this, podcast today and 100% of their money's in the stock market and they're getting ready to retire and your lifetime income is dependent upon the returns in the stock market. Now that's a different story. Now, again, we can answer these questions the way we're answering because of the way we do planning. I will say, if 100% of someone's money was in the stock market and they need to draw an income from it, then you absolutely need to be a lot more sensitive to timing, getting in, getting out, overweighting, underweighting. But that is a game that's filled with anxiety. It's a game that's filled with, does not lead to peace of mind, which is not what we want for people in retirement. So if you and I, and at Wise Wealth, if we were in charge of trying to control something we cannot control, give somebody an income stream from their investments from the stock market and it's going down, then we'd be panicking too. We say, look, we got to get out of the market because we can't afford to have this downturn, sequence of returns, all these things. So ultimately, we can with confidence say, no, leave the money in the stock market because we've already done something else. And that's one of the other principles. Protect the income, grow the rest. So I think it's important for us to say, we're saying what we're saying about the stock market because we've also already protected the income stream. We also protected whatever money you need for the next, that's a known or a planned purchase or expense in the next 3 to 5 years. So if you follow logically our planning process, then we could say, yes, you don't buy and sell. You don't get in and out. You stick with the plan. If someone doesn't have a plan like that, you're 100% in the stock market, you're trying to do a 60-40, trying to draw an income from it, then you need to be a lot more sensitive to timing. But at the end of the day, it doesn't work.
Well, and that's so you're saying that, again, the answers we're giving are predicated on following everything else that we talked about. And so that would be similar to, we've heard over the years, well, so-and-so, and I'm not going to mention his name, but his initials are Dave Ramsey, says that what we want to do is, and he'll give these steps, right? And they'll take a piece of that and say, okay, well, I'm going to invest 100% in mutual funds. Right. And so we're saying, okay, that may not be bad advice in and of itself, but it is also predicated on every other thing up to that point that you haven't done. And so It's the whole picture.
Yeah, exactly.
Makes the difference.
That's right. And that's why we tell people, even with the planning, when we tell people, look, we need to know what your purchases or expenses are in the next 3 to 5 years. We're going to protect that. We want to protect your income stream, make sure it has no stock market volatility. It's guaranteed lifetime, principal protected. Once you do those two things, you also then need to do the third thing.
Yeah.
If somebody said, with my growth bucket money, I'm going to be more conservative because I can't lose it. Well, no, at that point in time, you really can take on the risk. You should take on the risk. If you do parts 1 and 2, don't neglect doing the right thing in part 3.
Yes,
exactly. But if you don't do it like that, which again, obviously our clients do it this way, leads to less panic, more peace of mind, more enjoying life and retirement, giving, serving, all these things. But there are a lot of people who still believe they're just going to keep it all in the market, draw out 4% per year. They're not aware that one of the biggest stock market volatility risk is called sequence of returns. It's taking returns out of the market while it's going down and what it takes to recover from that. And it just doesn't lead to peace of mind. It leads to constantly having to worry about what's going on in the world, therefore the markets, because my income is dependent on it. That's not a great way to enjoy retirement, to have my income dependent on something that nobody can control. I don't care how diversified you are. I don't care how sophisticated you are. Nobody can control what's happening in the stock market. There's all kinds of things that are knowable that affect the stock market, but there's a lot of things that are unknowable that happen all of a sudden. COVID-19, terrorist attack, all the unknowable until they happen. So therefore, everyone thinks, well, I can just I'll be able to predict. That's why we do believe, we can't say it, more strongly enough. Protect your income stream. That's why you saved. That's why you invested. That's why you planned your whole life for retirement. You spent 35 years saving for it. Don't leave that to chance. Protect your income stream. Let the rest of the money that you don't need for an income stream do what it's supposed to do, and that is grow. And we do believe, regardless of short-term volatility, regardless of long-term volatility, we do believe wholeheartedly that the stock market will give us good returns over 5-year periods of times and longer.
Yeah. And that's where, we always talk about financial peace comes from having a plan. And so if you're watching this for the first time or listening to this podcast for the first time, so we're talking about all these things that those who have followed along or been on this journey with us understand. But if this is your first time hearing this, you can go back to the early seasons, season 1, 2, 3, where we really took a deep dive into the planning process and the way we do planning and all of that. So, so we do want to get all of that in context too. And so that's a great way to be able to do that. So, just the last question we have here really, and this one's a little bit different. But it says, how does my savings or retirement plan compare to others at this stage of life?
Okay. Yeah, that's always a good question. Sometimes people ask, am I on track? Am I doing as well as other people? Or, kind of like the same question asked in a different way is, do I have enough? Is this enough money to be able to retire?
Yeah.
And the answer to that question is always, there's a lot of factors that go into it. Everyone would love for me as a financial planner to just come up to a screen and just write down a number and say, hey, if your assets equal this number, you're going to be okay. Well, the reality is that number, whether or not it's going to be okay or not, is based on what is your income need, what are your income goals, what other assets you have, what are the sources of income you need. We have seen clients that have a very large income need and not a lot of assets, and they're totally fine. We've had clients that have a large amount of assets, a smaller income need, and they're in danger of running out of money. So it's not about asset size. You may have large assets, small income need. Okay, but you're going to spend all this other money. So the point is, whether or not you have enough, whether or not your savings is compared to someone else, that is irrelevant. We want you to know, what does retirement look like to you? Do you have enough to do what you need to do in retirement? We want everyone to be free to give, serve, and enjoy life. Do you have enough assets to do that? And the answer to that question is, it's unknowable until you have a plan. Okay. And so I would never say, because one person might have, $1 million saved, another person might have $2 million saved. The person with $1 million might say, we should probably have 2. Well, that's not necessarily the case. Depends on your income, what you're planning to do in retirement, what your goals are in retirement. There's a lot of factors there. Lifestyle, where you live. There's a lot of factors that go into it. So we can't just say a certain number, you're going to be safe. We can't say, one number is better than another number. We've seen all the numbers work. So it just ultimately comes down to your number. There's not a number, but there is your number. Every client has a number. That number is enough to say, hey, this is the amount of money, the assets that I have saved is enough to give me what I need for my short-term goals. It's enough money to give me the income I need for me and my spouse if I'm married, guaranteed the rest of our life. And it's enough for us in the growth bucket. That's the subjective part of this thing. Is that enough in the growth bucket? When the growth bucket in our context is money that you don't need to live on for your income stream. Is that enough? You know what I mean? If that's not enough, then you keep working, you keep growing, you keep saving it. But that's the key area where it's variable, where it's subjective. So the answer to that question is everyone has their own number.
Yeah.
I would never base it on, do I have enough like as someone else has, or what's the number I need to get to? It's always a subjective number, and everyone does have one. And we want you to get your number, but the only way to do that is, have a plan.
Yeah. And we always start with the question when we have our first clarity conversation, that's our process, right? So if someone meets with us for the first time, we start with a clarity conversation, and it's getting clarity around the kind of the W's, who, what, when, where, why. But we start with the question, what does retirement look like to you?
Yep.
Because it's different for everyone.
Right. Exactly.
Right?
Yep.
And so I would say too, as we start to wrap up these questions, a lot of what I've seen and what we talk about is someone once said that one of the killers of joy is comparison. Right. And so all of these questions, a lot of times are comparing it to someone else or something else they've heard.
Right.
Or,
someone else
my
is
neighbor
doing
did
something,
this, or my neighbor's advisor did that, or my neighbor has this in retirement, and how am I in relation to them? No, the judge should be what we compare it to.
Right.
Is your plan.
Right. How do you feel? Right. Is it meeting your needs? Is it meeting your goals? Are you happy? Are you free to enjoy life because the income is guaranteed? Are you sitting up at night worried? Are you anxious? Do you have a plan for long-term care? Do you have a plan for, all these things that we talk about, you mentioned even at the start of this podcast, all these areas that people need to have a plan for. And once you do, that's right. Your frame of reference, your comparison should be to your peace of mind.
To your plan.
How does your plan compare to your peace of mind? Not your plan compared to the guy next door.
Yes.
Is it leading you to peace? Is it leading you to enjoyment and retirement? Is it leading you to the freedom to give and serve and enjoy life? Whereas, it doesn't matter what they have. So yes, you compare it to the right thing, which is your own peace of mind and enjoyment.
Yeah. Absolutely. Well, those were some great questions. And I know as we put a bow on the season, talking about these things, that's a lot of it comes down to, in a sense, like we talked about, the person you see in the mirror is the behavioral aspect of things. And so understanding that and the plan really helps with that. So, so as we wrap up the season though, want to just kind of look ahead to kind of where we're going from here. And so this has been a great format.
Yeah.
And talking season by season is good because we're able to put together these things. So like one season we spent just on what does give, serve, and enjoy life look like? Yeah. What does that mean? Yeah. We've talked about the 3-bucket approach. We've talked about all these different things, and we've had seasons. Yeah. Right. And it's been good, but there's a limiting factor with it, which is we sometimes have to record when our guests can be on or when topics are relevant. But we can't just be reactive to maybe what's going on at that time. Right. Because we have this theme. Yeah. And so you want to tell us a little bit about where we're going from here and what that might look like. Yeah. Like you said, a lot of times we are in the podcast studio, we're recording the studio, and it may not come out for a month.
You know, make it depend on, a lot of times you and I will come in and we'll maybe do a couple of podcasts at a time, record them, but it may come out every couple of weeks. So, but yeah, I'm excited. So you'll kind of go away from the season format and just go to the next podcast, whatever comes up. And so therefore we're not tied to, like you said, a certain theme. And so one of the constricting things is trying to find maybe a guest or find a topic that fits within that theme. Now we can just be open-ended, whatever is relevant to the time. It could be relevant because our clients are asking about it. Could be relevant because of what's going on in the news, and it'll allow us to push the podcast out almost right after we record it. So for example, we could record a podcast today and have it out, tomorrow, those kinds of things. So it's going to allow us to be more timely, let's say, and they're going to come out sooner. So even for example, sometimes we'll sit here and say, it's snowing outside today, and then the podcast doesn't come out for a month and it's not snowing. Now, again, we're in Kansas City, so that could change any minute now.
Yeah, so, it could change from minute to minute.
Yeah, so, so it's going to allow, we're basically just going to go to a number format, and so instead of saying seasons, it's going to be podcast number 52 or podcast number 99. We'll just do the next podcast. The podcast, 74 might be relevant to 75 or might be something totally different. That's the point. It's going to allow us to just talk about anything we want to talk about, need to talk about, and come out a lot sooner. And by the way, we haven't really talked about it. I don't know if anyone's noticed or not. Okay. But we've also made upgrades. We made a major investment into our studio capabilities, to the look and feel of our studio. We literally, in the middle of this season, even moved from one studio room to another room. We never told anybody. We didn't know if anybody noticed or not, but I don't want to talk about it, Paul, until until the season's over. So I'm not going to tell anybody about our new desk. No. I'm not going to tell anybody about this new room until next time. So the next podcast we do, stay tuned. We're going to tell you about this new studio that we're in.
Well, and it's funny. I reflect back over the years that we've been doing the podcast too, and think back to when it started. It was just audio. And we were working off of a card table set up in this little corner of a room.
And we found a room in the office that wasn't being used, and there we go. Exactly. That's right.
And so it's been a fun progression.
Absolutely.
And so this is all good. I know from a standpoint of being able to refer back to things, just having numbered podcasts are going to be easier to find than season whatever, episode whatever,
Absolutely.
just to say, episode 45 or whatever. And so that's going to be a great change for that. And so I'm excited about where we're going. It's been a great ride up to this point, and definitely loved having all of you along the way. And if you're joining for the first time, or you're sharing this with someone who's never seen this before, we do have a whole lot of episodes that you can go back and listen to, and many of them watch on YouTube.
Right.
All of them should be available on audio podcasts as well. But great way to be able to understand some of what we've been talking about today when we talk about the planning process. And for you, if you don't have peace of mind because you don't have a plan, or you don't know if your plan is right for you, give us a call. We're here for you. That's why we do what we do, is to be able to help people put together a plan that gives them the freedom to give, serve, and enjoy life like never before, so they can have that peace of mind and be able to truly go and give and serve and enjoy life, even when things seem like they're falling apart out there.
Absolutely.
Right? And so that's why we do what we do. So give us a call, and it starts with just a simple conversation. The clarity conversation. Where are you in relation to your goals and what retirement looks like to you? That's where we start. So it's very simple. Give us a call, 816-246-9473. That's 816-246-WISE. Or email us at info@wisewealth.com. When you're talking to us, also request a copy of Stephen's book. Simplify Your Retirement has just been updated, and we'll get you his newest copy of his book. And we may even be able to convince him to sign it inside too.
Absolutely. Be glad to do that.
So, Stephen, again, thank you for the investment of not just time, but finance, everything that it takes to get this going. Thank you for that. I know that those listening appreciate it. The education that we continue to provide for anyone watching or listening is great, but especially for our clients.
Right.
I know it's something that we value,
right,
and we want to add that to the relationship that
Absolutely.
we have with our clients.
For sure.
So thank you for doing that. Again, our last thank you goes to you, our listening and viewing audience. You're the reason we do this. So without you, we wouldn't be here. Without you, we wouldn't be moving on and keep moving forward. But we do appreciate you taking time to share. It helps get this out to more, it helps get this information out to more people when you when you share all of that. All the algorithms matter. And so, but like and share, and it'll also notify you when the newest episode comes out. Makes it easier to share, makes it easier to watch and listen. So again, thank you for tuning in. From all of us here at Wise Wealth, this is Paul Brock saying, remember, financial peace comes from having a plan. And we'll see you next time.